12:30 p.m. only on Bloomberg Quint.
The fourth quarter has its share of performers as far as earnings are concerned, but it wasn't enough to cover up for the misses that led to the numbers falling short of Morgan Stanley's estimates. But more importantly, Morgan Stanley is hosting the biggest of the corporates as well as the market participants in their annual India Summit, the 21st Annual India Summit, talking about envisioning the next India. And Ridham Desai of Morgan Stanley with us to talk about what investors would be watching out for, what will be their message to the investors as well. Ridham, apt time to have this summit as well. Good morning to you, of course.
Good morning.
What is the central theme of this summit?
Yeah, so this is the usual time we have it. We get lucky every 5 years because it comes immediately after the elections. There was a time when we used to do this in February, but that changed after the unfortunate attack on the Taj in Colaba. So that year we got disrupted, and then since then it's been a June timing. We have, it's actually the longest and the largest investor conference in India. Largest, I'll say with a little bit of caution because official numbers about other conferences are not available, but it's certainly the longest surviving one. We've been doing this since 97.
Yeah,
okay,
21st.
So, yeah, 21st now. Yeah, there was 1 year in which there was a gap. So yeah, I think 97 or 98. Yeah, so 21st. I've attended all of them. So the theme actually, so we don't actually carve out a theme as such, but it kinds of forms up based on how, speakers that come through. I think I can identify 3 or 4 main things that are happening. So I think the first one is macro and politics. Now people think elections are over, so politics is done and dusted, but actually it's not. Because in the next 12 months, we have another 9 state elections. And just after a gap of 3 or 4 months, in fact, just 3 months, campaigning will start all over again. Crucial state elections are happening in October. And I can bet that the market will once again start focusing on all these things. It is never done and dusted. But more importantly, I think there are other issues around politics, like policy, like geopolitics, and these are not yet done and dusted. In fact, policies will roll out now. So there's a fair bit of discussion around macro and politics. I think the second theme is disruption. There are quite a few sectors that are undergoing change. Take, for example, the car market, or I should say that the whole commutation or transportation market, because it's cars, two-wheelers. A lot of these things will have completely changed in the next 5 years. Electric is the buzzword. There's shared mobility. There's driverless cars on the anvil. There's something that we call the second machine age, which is manufacturing will go through a big change. Manufacturing went through a big change at the turn of the previous century. That is the start of the 20th century because of alternating current, electricity. Until then, factories were not designed for alternating current, and a lot of companies decided not to restructure their factories because it was so painful, and they got disrupted and fell by the wayside. Those who had the courage to respond to new technologies obviously survived and grew bigger. So similar type of challenges are there today, either in the form of artificial intelligence or robotics. Now these may seem far removed from today's market debates, but they will be upon us in the next few years. So that's the second thing. The third thing is I noticed that there are a lot of C-level participants who are talking about the transition in their own businesses. So you can say business 2.0. Where the word business can be replaced by the respective company name. Okay. A lot of companies, I think, are going through this transition where their business models are moving to the next stage, either because the external environment is challenging them or because they are making the choice about how they want to run their business or where they want to go next. So I see a lot of that coming through in the corporate presentations. And I think finally, maybe a little bit on philanthropy, because I think that's also very important, and giving back, which is a core Morgan Stanley value. So we have that a little bit in the conference. So a few themes there, and I think I'll be in a better position post the summit to actually distill what all has come through. Maybe other things also happen. I can't predict all the content or the interactions up front.
Well, maybe we should either do read out your note as you write it post the conference, or do a conversation again. We're happy for both. Let me try and ask you on a couple of those things. So you, as I see, are moderating an event or the first panel discussion too, with one theme that you spoke about, the global head of auto and shared mobility of Morgan Stanley, and you have some presentations from other auto companies as well in the conference. What is it that you are searching for in terms of answers, Ridham, at this conference?
So see, the immediate concern for investors is this slowdown. I don't think investors are particularly focused on the technology changes that are coming into the sector, which is something which is beyond the next 2 or 3 years. So I think the immediate investor focus will be on, is this slowdown over? And I'm betting that it is actually mostly done with. So I think we will see the numbers getting better and better. And certainly it may take another 2-3 months for that to show up, but the stocks are to be bought now. In fact, I said that about a month or so.
Last conversation,
Yeah, so I think the stocks are, because the market will anticipate that, and the stocks will start moving, and they probably have already started moving. It seems like the worst of that slowdown is over. That slowdown was precipitated, I think, by the liquidity crunch in the banking sector, mostly non-banking finance companies, as well as I think some lack of anticipation by auto companies about the slowdown that came in the last quarter of last year, which meant that there was inventory that got built up. And the third factor is elections, because elections, cause a lot of cash drainage, and the RBI's, the government's balances with the RBI's tend to swell. And this has an impact, and it's typical of every election period. General elections, you go back to 2014, we had a similar type of impact on consumption. So all these things came together, which has hurt. So it's I would say it's not cyclical. It is only, if I may use the word seasonal, temporary impact, which will now wane as government expenditures start rolling out. So post the budget, I think you will see that impact come through in the auto markets.
Okay, so that view being formed about what it means for the investors in the near term is one thing. Is there something that you yourself, you would have figured out most pieces of the puzzle, but is there something beyond the 2-3 years part that you spoke about, the shared mobility and the electric cars and the disruption thereof, that you would believe some answers could come out? Because I see you have Maruti as amongst the participants as well. There are some financiers who finance these auto companies also a part of there. Anything that you see?
So you assume that I've figured it out. I haven't figured it out. We will figure it out as time rolls out. But my auto team has been on top of this. We published an electric vehicle shared mobility research piece for India last year, which was, I think, a key anchor to the Prime Minister's electric conference in last September. So it was a widely used document by the government. Over the weekend, we have produced another one which is just focused on two-wheelers. So the last year one was on four-wheelers. Now this is the one on two-wheelers, where we think the disruption is this year. Okay, so electric two-wheelers will start rolling out. The big difference between electric two-wheelers and four-wheelers is in charging infrastructure. So the charging infrastructure for four-wheelers is enormous, but for two-wheelers it's not. The battery can be almost carried by hand. You can charge it at home. You don't need a ubiquitous charging infrastructure. Two-wheelers don't travel long distances. You don't do intercity commutes with two-wheelers. So it's a lot easier to put two-wheelers. And there are a lot of startups in Bangalore which are working on technologies to do this. So hopefully we'll get some more insights around this, on how ready the market is, and how quickly this can happen. And this could be actually something that is far more topical than the four-wheeler thing, which is going to take a little longer, because it also is a function of how quickly the infrastructure for charging comes through.
Yeah, well, day two, I believe you have Ather Energy, which is speaking, I believe, as a part of the panel on the electric two-wheelers and how they are coming. Okay, that's interesting. You spoke about disruption as being one theme, and I wanted to take off from there. I see a lot of large blue chip financial names speaking at the conference too. Is the attempt to try and give investors a perspective of whether the bigger and the better ones are only going to get bigger and better? And if that is indeed the case, is that the view that you hold too? Because we are seeing the men getting separated from the boys. But what the last quarter Ridham has shown is that the mid-sized banks, not the NBFCs, but the mid-sized banks are starting to put their best foot forward in terms of reported numbers.
So I don't think it's large versus small. I think it's more to do with how your business is funded.
Okay.
So it's wholesale versus retail. And the wholesale funded entities are going through a unique, or I should say, cyclical stress because of what has happened over the last few months, and because they are sitting on overextended balance sheets. So they have to go through a period of balance sheet consolidation, building of liquidity, building of capital, and hence slow down. And when they slow down, the retail franchises will pick that market share up. Now, within the retail franchises, you have two sets of banks. One that were not affected by the NPL cycle, the previous 5 or 7 year NPL cycle, and the ones that were most affected. The ones that are most affected from a stock market perspective are the ones that are going to come back most strongly, because we think that the NPL cycle is mostly done. And the few NPLs that have emerged in the past few months, I think is the tail end of this NPL cycle. So we're done and dusted. The provisionings are going to fall, and the earnings for these banks, as you've seen in this quarter gone by, are going to be quite strong, and the market is still not fully priced that in. So we are looking at very strong earnings growth. Now within that you have mid-sized ones and you have large ones. So I'm not distinguishing in size. I'm just looking at the ones that were suffering the most from the NPL cycle and have a reasonable retail franchise to build liabilities and therefore fund credit growth. Okay. And then of course the remaining ones, which are the ones that have not suffered the NPL cycle. Now those are a handful of banks that have done exceedingly well over the past 5 or 7 years. They've been the best performing stocks in India. And I reckon that they will continue to grow. They may underperform the other lot, but they will continue to do well in the context of the stock market. So it's about how you want to build a portfolio. You take very little risk with these banks. They're extremely well managed. They have supreme risk management practices, and they should always be part of a portfolio. And the other ones are where you could get a very strong delta in performance.
Okay. What did you
The wholesale banks, I think, will have to take a bit of a break. Now, within the wholesale banks also, there are two varieties. One where I think the capital is constrained. The others where the capital actually is quite okay. And there are a good, there are some really strong wholesale banks, some of them coming to our conference as well, which I think will do very well. And in fact are also in the list of the best performing stocks of the last 7-8 years, and I don't see any impediment for them to actually grow their balance sheet. So again, you can't use the word wholesale and put everybody in that basket. You have to differentiate between the strong and the weak ones. The weak ones are the ones where I think investors made outsized money in the last 4 or 5 years because they were growing very rapidly. And as we saw with the corporate banks, when they grew very rapidly between 2008 and 2011, they basically inherited a lot of NPLs. That's what happens to banks. Always be afraid of banks when they do 30% CAGR for 3 years on the trot, unless you're extremely confident of their risk management practices. Because when you're doing that type of growth, you're invariably building some non-performing loans on your balance sheet.
Okay. What did you make of the developments on Friday, the new June 7th circular, as we call it? There is also some developments wherein SBI is now starting to move on to a new benchmark for, I think, home loans as well, and what it does to housing finance companies. So what have you made of all of that?
So I think there's a distinct shift in the central bank's thinking about the economy. So I would say the last 2 years, the economic performance or lack thereof has been largely a monetary phenomenon. And I think we're now moving away from that. The RBI has been very successful in reining in inflation and now sees the need to be a little bit more sensitive to growth. And therefore you can see that in the RBI policy. It's now going to be accommodative. Liquidity is most likely neutral, if not surplus. And I think that is great news for growth. So I would not get bearish on macro growth for the next 12 months at all. I think we're in a period where growth is going to be strong. The only caveat here is global factors, which we don't control. And there could be some bad news from the globe. We'll come back to that later. Now, the circular on Friday, I think, is very good. I think it's extremely good rectification of the experiment that the RBI started last year. A lot of feedback came. Some of the things that they had put in the original circular were not practical, like the one-day default thing. And I think this is a more practical circular. This is how business is done on the ground, right? So it reacts to the needs of the banks. I think there's greater trust imposed on the banks here to take the call, which is the way it should be, right? The banks are running a business, and I think you should trust them to make the call under the framework of the supervision that the central bank has. So this is a very good circular in my view.
Okay, you mentioned the globe. Would you want to dwell on that a bit?
Yeah, so the globe, I think, has got this challenge coming from the spillovers of the trade war. And while we are generally immune to that as an economy, I don't think we're completely immune.
Okay.
To that extent, if this trade war thing morphs into a bigger problem, then it could slow down global growth. It could even take the US into a much slower growth profile in the next 12 months. And that will have an impact on India's growth rate. So we cannot operate in isolation. You know, as I keep saying, India is the 7th largest economy in the world, 6th largest, and it cannot operate in isolation. So to a certain extent, it will get affected. So I have to caveat any absolute growth targets with the global situation. Now, one of the collateral positives that come out of a slow growth is that the Fed will be off the pedal. Which is okay, which allows India to maintain softer rates, which is what India needs right now. If the Fed was on the pedal, then it makes it harder for us to respond. So we can actually afford to have slightly lower interest rates in line with our lower inflation, while the Fed and the US deal with the spillovers of the trade war.
Maybe oil also stays soft, but just...
Oil is a direct function of growth, and I don't look at oil in absolute terms. I look at oil always relative to copper.
Okay.
Copper and oil both have got two dynamics in it. They respond to global growth and they respond to their own supply idiosyncrasies. And it's very hard to differentiate that in real-time basis. So the way to differentiate is you do oil relative to copper. That takes the global growth factor out. If oil is rising relative to copper, it is largely because of idiosyncratic supply factors. Right now, oil is falling relative to copper, and if you go back 20 years, that's great news for the Nifty. The Nifty tends to outperform when oil is falling relative to copper, which means that oil has got positive supply dynamics from an India perspective.
Well, maybe a chart idea as well at some point of time. Ridham, one final question. Because a large portion of our clientele is global in nature, what do you think happens over the course of the next 12 months? We don't know which way the global trade war pie will shape up, but what about flows? What are clients telling you? How comfortable they are putting money into India?
Yeah, so I keep saying that I get half my calls wrong, half of them right. Right. So one of the calls that we got right at the end of last year was a call that foreign investors will be back, and they are back. And I think this sustains for a while. Now I'll give you the framework for that call. The framework for the call was that foreign positioning in India was at multi-year lows and had fallen to 2011 levels, and they were very light on India. And it just required a little bit of outperformance from India for them to turn in, and that's what has happened. I think India has outperformed, and foreigners are back. And that's how it happens. So flows are a direct function of how you perform, not the other way around, as most people think, but it's actually performance that drives flows. And to the extent that India looks like the place which will outperform EM for the remainder of 2019, I think flows should be quite good. It's evident in the interest that we are seeing in our conference, over 450 investors, so there's a lot of interest in India right now.
Okay, this was essentially to get your thoughts on the markets at large. Views on the conference maybe a bit later on, Ridham, but thank you so much and all the best for the conference.
Thank you so much, Neeraj. Thank you.